All right. Well, given we have, oh, um, I'll welcome everyone now. I'll get things started. So, welcome everyone. My name is Ben Welly. I'm Director of Integrated Transport at the WRI Ross Center for Sustainable Cities, leading work on public transport and innovations, as well as other aspects of our work here on sustainable mobility. Which is how can we engage the private sector with new mobility opportunities in cities. And one thing we've been doing is looking at, in two cities, Kampala and Hyderabad, how can we engage with new mobility enterprises and with government to increase synergies between the two, as well as think about how to drive more investments into sustainable urban mobility enterprises. Today, we are launching a paper which is called Impact-Driven, and appropriately named webinar, which is Impact-Driven Investing in New Mobility Enterprises, Perspectives from Kampala and Hyderabad. And what we're gonna do is have a presentation about what this paper is saying and what we've found in this research on new mobility enterprises and impact-driven investing in these regions, with some reflections on how this might be improved. We're joined by a great panel of global and regional experts on these topics. After the presentation, we'll have a conversation with with our panel, which we'll introduce after the presentation. But first, I'm going to hand over to my colleague, Hayne, who is going to begin a presentation. And I will say, before that, please feel free to say hello in the chat. We'll have a brief Q&A from the audience if we have key questions after the presentation. So type in your questions to the all panelists and attendees. You can do this while the presentation is happening, and we'll monitor that and get to your questions right away, one or two right away after the presentation before we go into the panel. And then, like I said, please say hello. We want to hear from you. We're not doing this in person, and we're probably all getting tired of webinars. So if you can try to make it more personal and let us know who you are and where you're from, that would be great. So Hayne, without further ado, I'm going to hand it over to you. So go ahead.
Hello. Hi. So as you know, this is because of this paper launch we are doing, which is called Impact-Driven Investing in New Mobility Enterprises. It's a bit long title and perspective from Kampala, Uganda, and Hyderabad, India. My name is Hayne, and then these are the other colleagues that contributed to the paper, and you can find the paper at the link. Hopefully you can see the link. Well, for today's, these are the authors and panelists that are joining with us. I'm Hayne Toon, and then Adam Davidson, we'll have Chaitanya and Anna speaking, and then these are the following panelists. Do you want to introduce a little bit the panelists?
I think we'll introduce the panel after your presentation, so you can go ahead.
So there are two main parts, as you might be glimpsing from the title: the new mobility enterprises and the impact-driven investing. So those are the two main themes of the paper. And new mobility, the way that WRI has defined as you have quote unquote the traditional mobility, where you have interactions between mobility access and regulatory and operations models interacting. What is new, broadly defined new, is the part about data and ICT, information and communication technology, and how they reconfigure who owns what and how you do the delivery, and how you're redistributing the access spatially that like use like demand. That's the kind of definition that we have used. And based on that definition, you can have four, we are dividing the new mobility services into four different interrelated cross-cutting subcategories: share mobility, user experience, data-driven decision-making, and product innovations. As time goes on, those four buckets are becoming to interact more and more, and share mobility takes a large chunk of the ecosystem, and then they interact with more like a product innovations and other buckets happening. And then there are also different evolutions happening within share mobility, for example, in India. So the other main theme is impact-driven investing. In order to explore impact-driven investing, we look at the definitions of impact investing, which you may be familiar with that, which is explicitly trying to seek financial gain, and while at the same time also generating measurable societal and environmental benefits. So that's the idea is you can seek revenue and financial gains, and also get a do good, measurable do goods. So they are different. They started with a long time ago. They started with this ideas of targeting the bottom of the periods, who might not have be targeted by the traditional conventional commercial things, but that definition is also evolving and changing. That's why not always is highlighted. And then there are the chart kind of shows how impact investing is different from other type of investing. There is the discussions. I hope we will probably get into in the panel discussion sections, where this idea that in some spaces there's a choice that you have to use between finance versus impact first, and then there are also wide literature that's argue you can achieve both. So the question that we're more interested in for this discussion is, can you do that? To what extent can we do that in transport sector, specifically among the new mobility and enterprises? Then there is this term that if you're coming from finance, you're already familiar with, where the ideas of using risk tolerance capital, patient capital, and then expecting much longer term time frame, so that conventional investments, like if you want to give more time to the innovators to test out their pilots, they can kind of relay on that kind of capital. So that's the definition that might become useful in the future presenters, like in future presentation. So like tying the two back between the impact investing and the mobility enterprises. So we know the mobility enterprises can have a lot of positive aspects, such as road safety, improve road safety, reduce air quality, improve air quality, reduce air pollutions and GHG emissions, and increase access, especially for those transport disadvantaged people. But we also know that the entrepreneurship doesn't always mean they're always aligned with the interests of the broader public at large. So, and then there are also other questions around how do you actually measure impact, positive impacts that clearly communicate to them, because we also want to avoid things like impact washings and greenwashing. So the chart kind of shows the new mobility enterprises. If you already familiar with this life cycle chart, most of the enterprises are usually at this space of values of debt, where they're trying to overcome. Maybe if they are impact oriented and impact driven, there's the two can align. So that's what this paper is trying to explore, like essentially the practice of impact investing in the transport sector, and then to see if they are compatible between, if there's a compatibility between impact investing and transportation delivery, and identifying opportunities and barrier to amplify net positive impacts. And we're doing that by using a bottom-up case study approach in Hyderabad and Kampala in 2 cities. A brief overview of the methodology: we first conduct preliminary desktop research, and then we conducted a series of semi-structures and structured interviews in the 2 cities. These are the list of some of the entities, organizations we have interviewed, and we asked these preliminary the questions, and then we group them and analyze the findings based on if they have common trends and other interesting features that we find from that you can read more in the paper. I will hand it to Adam, the next part.
Good morning, good afternoon, depending on where you are. So going in a little bit deeper, we had to examine in a way the nature of transportation as a field and how it matches with the concept of impact investing. So we had to break it down a little bit. And one of the things that we point out is that transportation itself is considered a derived demand. It really provides access to other opportunities, but it is not itself an end goal. So because of this, the impacts of transportation can be naturally pretty broad. And I think that is in a way exemplified by this look that we did at what SDGs could be realized from better transportation. What this means is, because the impacts can be broad, finding the appropriate metric, finding the appropriate value for the appropriate metric in a transportation context can get a little bit fraught. These values really exist in the context of an entire socio-economic system, not just because of some actions made by a transportation provider. You can think of things like gender equality, where certainly services that target usefulness towards women help, but do they actually realize the opportunity is a bit more difficult to figure out. Another example is if you're looking like the climate action one, where the transition to electric vehicles emphasize greenhouse gas emissions generally, but in emerging markets, what they're really looking for with any kind of transition like this is to get towards strong economic development as an outcome as well. So it's that the context of where these things are happening and what else is going on really matters. Additionally, a firm, an enterprise, does have a strong incentive to focus on positive impacts. Say, for example, access time, something like that. But it's harder to either quantify the negative ones or even if when you can quantify them, there are fewer incentives to be talking about them. For example, congestion. Next slide. In the paper, there's a lot of text on these slides, and for sure you can get a lot more of the details in the report. The point here is that we tried to take a look at the potential synergies and trade-offs, because like we were saying, there are both positive and negative externalities to consider, where context really makes the difference. And you see this a little bit in this chart. For example, universal or broad access can attract more users towards more trips, but it can also be at odds with time-sensitive service sometimes because it can lengthen running times, things of that nature, but also the financial wherewithal of services to provide transportation out into less dense areas. So there is, just within the operations of an enterprise, there's that tug right there. There's also situations where maybe increasing the use of non-autos, alternative transportation, buses, scooters, bikes, walking, those kinds of things, can certainly lead to improved safety outcomes, as it can reduce the chances for high-speed conflict. But on the other hand, you need good pedestrian space and good delineation of road space for other uses, and people who respect those spaces so that are maintained appropriately and whatnot, in order to provide a safe environment for people outside of the vehicles. So there are these synergies and these trade-offs. Next slide, please. So before getting into the case studies, we tried to think a little bit more generally about what this could look like at an enterprise level. And we wanted to show both barriers and impact opportunities. Looking at the ride-hailing space, we thought about that as it's relatively established at this moment. We see the barriers as being issues of cost, competition, and congestion. For any transport in an enterprise, there definitely are barriers to cost. Transportation generally has a high barrier to entry. Vehicles are expensive, infrastructure is expensive. You need to find a way to utilize those things. And in the case of ride hailing, it was really around information around those things where they innovated. They had a business model where they weren't buying cars, and they weren't creating new infrastructure. They were relying on infrastructure that already existed. So it shows about the opportunity that they took to really leverage existing capital with information technology. In terms of competition, the competition exists everywhere in the transportation space because you're competing with modes that already exist, and you're competing with maybe services that are like yours, but maybe just offer a slightly different niche. But competition is very good in the transportation space in that it can keep things affordable for the end users. But I think even more importantly, it having more operators or more services, I should say, having more services means that there's a little bit more resilience in the local transportation system, and it adds reliability for an end user who can go about their business and know that there is a way back home. There's a way to get out. There's a way to come back. There can be more of a backup plan, so to speak. But for an enterprise, it also makes them be very aware of having a good business model that is cost conscious. And then congestion was another aspect that came up, and that relates to how we're talking about potential trade-offs. I think in the case of ride hailing, there was the services, due to roughly the ease of booking and the coverage that they offered, provide very good access for end users. But in a way, societal access becomes a little bit more difficult, as they have been shown to add towards congestion, at least in the popular areas where people tend to be heading, a car takes up the same space, whether it's a ride-hail vehicle or a personal car, et cetera. So to the extent that impact metrics can help lead towards space efficiency, you can help, there are opportunities for helping to solve that issue or focus on that issue a little bit better. The pool services, which have been suspended over the pandemic, were an attempt in that direction. So moving forward.
Thanks, Adam. This is Anna, and I'm going to take us into one of the case study cities and show how some of the things that were just mentioned by Hayden and Adam play out on the ground. For those of you who don't know Kampala, it's a relatively small city at about less than 2 million people, but it's a very quickly growing city. So it has a 5% annual urban growth rate. And the country of Uganda also has quite a quickly growing population rate, which is partially driving the urbanization. And as you can see from this photo, transport services are, you could say, chaotic or dynamic, depending on how you're feeling that day, but they're fragmented. There's a number of different modes, ranging from a limited passenger rail service with just a few lines to a small number of large bus companies that have maybe 30 or 60 seaters. And then you have a large number of taxis. These are the 14 seater minibuses, a very a rapidly growing number of private cars as people move into the middle class and the country's economy improves. Also a lot of two-wheelers, a small number of three-wheelers, and then walking is actually the dominant mode of mobility for a lot of the low-income residents of the city. So this picture sort of sums up the mix that we're looking at. What you don't see in the photo is actually the rise of new mobility that's happening in the city. So if you go to the next slide. This is, what's happening in Kampala is following trends of cities all over the continent of Africa. This map shows you all of the different mobility companies across modes that have been documented. And I would say it's not comprehensive because when you go out into the city, you'll constantly hear of a new company that started or see an advertisement on TV. And companies also close quickly. So this data, I believe, is from 2019, and I'm sure it's changed a lot since the map was made. But Kampala is, earning a reputation as an enterprise magnet within East Africa. There's many gaps in service provision in the country. You also have a large youth population with a strong interest in technology, and then many sectors are lightly regulated. So it's providing an opportunity for private sector and especially private sector startups to come in with ideas and solutions and help solve some of the daily problems that people have. And you can see Uganda is on the right side of the map. And there it shows the mobility companies that were in operation at the time that the map was made. Next slide. So WRI conducted this research sort of underneath the umbrella of a project that we were running called 3I Mobility, and that was in partnership with the Shell Foundation. And the 3 I's stand for innovative, inclusive, and impactful mobility. And the goal of this project is to understand the landscape of companies out there. Who's doing what, and what are they offering, and what are the impacts these companies might have on the city. And then I would say more importantly, the goal of the project was to find opportunities for these companies to network, to grow, and to build relationships with government. Next slide, please. So this is going back to the taxonomy of different types of companies that was introduced earlier. And Kampala is similar to global trends in that the majority of new mobility companies are shared mobility companies. And I would say, you know, these are companies that actually come and go quite quickly. There are a small number of companies working on what we call the back end of the user experience. So they're kind of partnering with maybe a transport service provider, but they aren't a service provider themselves to make the experience a little bit more seamless or more convenient. There are very few data-driven decision-making companies in the city, and it's because it's a complex space and access to data is very difficult. And because the transport system is so fragmented, you don't have companies and government sharing information across modes or across service providers. But this is an area that we feel would really make a difference in the industry too. And there's few people in this space. And then we have product innovation firms. A lot of this is fintech and kind of looking at how you make transport services more efficient and more effective. Next slide. So when it comes to financing of these companies, we started this study looking at impact investment into the transport sector. And we really didn't find much in Uganda as a country, and a limited amount in East Africa. The chart on the left shows all of the different impact investors that are operating in Uganda, but not necessarily in the transport sector, across various sectors. What we did find was a large number of projects and investments that had more of a philanthropic nature. And that's the table on the right, that were either being run through an NGO or through a DFI, which were focused on transportation and kind of improving the transport system for the benefit of the city and the residents. Next slide. So in conclusion, and we welcome questions on any of these points, that one of the reasons when we talk to impact investors why they weren't interested in the transport sector is that the regulatory environment is very opaque, and there's a big risk from the investor perspective that if they put money into one of these companies, the company wouldn't be shut down the next week, or there might be like a series of taxes and levies that weren't expected that would be imposed on the company and make the business model difficult. Another finding is that there's actually there's a gap in the market. So it's actually the fact that there isn't a strong public transport system, which has universal access, which is managed or even partially managed by government, means that there's a space for the private sector to enter this market. And we're seeing that happen. Another finding was insufficient access to finance. It was really easy for companies to get small amounts of money as part of a competition or maybe a one-off, but getting money for scaling up and really growing a business beyond seed and startup stage was difficult from our research. And then we also found that there were few medium-sized companies that were maybe ready for venture capital or impact investment in their growth stage, but there were many, many great ideas and initiatives that were out there that sort of could use support, financial and capacity building support, and were potential solutions to help solve some of the transport challenges in the city. But they were at a very, at a nascent stage with exception of a few companies. Next slide. And I'll hand it over to my colleague, Shaitanya, to talk more about Hyderabad.
Thanks, Anna. I will be speaking about the second city which we undertook as a case study for better understanding the new mobility ecosystem. Next slide, please. Hyderabad is a very different city from Kampala, which is partially the reason we chose it. We wanted to understand what the framework looks like for the growth and impact of new mobility across different types of cities. Hyderabad is in the southern part of India. It has almost 10 million residents. It has a strong transit network, public transit network with about 900 bus routes and 68 kilometers of rail, but transit ridership is in decline as the city grows because transit networks are not growing at the same pace as the city is growing at. Private vehicles are increasing in number at about, I think, 10% per annum is the growth rate of two-wheelers and four-wheelers. And Hyderabad has one of the highest contributions from the transport sector in terms of GHG emissions across all cities, even in India. A significant share of commuters still walk and bicycle, but these are typically for shorter trips and typically are restricted to the lowest income groups as time goes on, with who are sort of captive mode users of the sort of low cost options. And when it comes to the new mobility ecosystem, again, while India itself has over 1,200 new mobility enterprises, one of the largest new mobility ecosystems in the world, Hyderabad itself has over 100 mobility enterprises, again, with more than 50% accounted for by shared mobility, and with several enterprises also working in e-mobility and IoT-related innovations. The slide shows a few statistics in terms of the mode shares. The pie chart on the right shows that buses and two-wheelers do remain the predominant modes of motorized transport, while auto rickshaws and cars are also other important modes of transport. So it is a very diverse motorized ecosystem. Next slide. So diving a little deeper into the new mobility ecosystem of Hyderabad, you can see that there is a wider variety of companies in the city. Nevertheless, a significant number of them are still cab ride-hailing companies, many of them being traditional taxi operators that maybe have shifted to a tech-based platform or started becoming asset-light by divesting their fleets and actually inviting operators to join their fleets. So it's a lot of traditional taxi operators that are trying to compete in the new ecosystem right now by moving into by adopting technology-based solutions. The user experience area as well is both for transport service commuters, which is more the trip planning type of applications, and vehicle drivers as well, which is more the parking solutions and other such personalized applications. The data-driven decision-making insights, again, there are fewer here, similar to the case in Kampala, where you have insights either for businesses or for city administrators. So corporate employee transport fleets are very obvious data-driven decision-making sort of enterprise, whereas on the city administrator side, you have road safety, traffic management, and transit solutions. And finally, product innovation is primarily comprising electric mobility solutions in the manufacturing space. Next slide, please. When it comes to investments in new mobility, we can see that the investments are fairly significant and start peaking around the 2018-2019 period. 2020 is an anomaly due to COVID. And the top chart shows us the extent of the funding itself, which is about $700 million in 2019. We have not included Ola here. Ola is an Indian ride-hailing company, which is a unicorn, which in itself raised over $4 billion over the past few years. So that was a significant outlier. So we removed it from the analysis. But you can see that investments continue to grow, and that's largely because the later stage investments are growing. The lower chart shows that while seed investments have not really grown significantly, you can see that the Series B and later stage investments into these companies have started growing. A lot of the investments, if not almost all the investments in the mobility sector in India are from venture capital. So on the left, we've listed a few of the different investors, venture capital investors that invest in the space. There are very few impact investors and foundations that have made mobility investments. And one thing to point out here is in most cases, they continue to make their investments on the basis of very traditional metrics like number of jobs created, and are not really looking at transport metrics like accessibility, because, well, the metrics data is also very difficult to come by. Next slide, please. So here we've just spoken about the barriers to impact investments as well as some opportunity areas. The barriers are somewhat similar, maybe in some ways, to the barriers expressed in Kampala, but very briefly, there is a lack of understanding of the impacts of mobility enterprises, and net impact is difficult to capture in the mobility sector. There are inflexible regulations and bureaucratic procurement processes which can hamper the growth of enterprises, especially given a lot of the most impactful enterprises like transit solutions require government to be a client, especially for public transport or road safety, for example. And while there is a lot of capital, it's not lacking. Impact-oriented and sustained capital for certain high-impact areas, be it low-income transport or safer transport for women, for example, this is lacking, and as a result of which the enterprises that come up in the space also are not able to sustain. On the right-hand side, we have highlighted a few impactful areas of potential investments where, like micromobility, paratransit services. Again, I won't go into this in the interest of time, but this is also available in the paper, which basically says there are areas which are creating impact, and impact investors can look at it, even though currently they are not. Next slide, please. So that's it for the Hyderabad piece. As a final sort of, the final part of the paper essentially highlights 3 key recommendations that were framed in the context of understanding the opportunities and challenges that existed from the investors as well as the companies themselves. And the 3M Mobility program that we were speaking of actually tried to put some of these into practice, and the project itself is what we're using to test some of the efficacy of some of these recommendations. The recommendations being to demystify policy frameworks and increase advocacy processes for progressive reforms. So creating that space for companies and governments to be able to speak. This is happening more naturally in some places, like as the ecosystem grows and matures, companies themselves start hiring policy advisors and start liaising with the government. But at the same time, the smaller companies that may require support get lost in the process. Develop tailored impact measurement indices to capture sustainable mobility outcomes. Again, as I was saying, transport-related outcomes like cost of transport, accessibility of transport, time taken, all of these are not necessarily captured because there are no known metrics in the impact investing world to measure these. And transport has not traditionally been defined as an impact measurement, impactful sector for impact investments. And the third recommendation is to create coalitions and demonstration platforms that support sustainable mobility alternatives. And this is happening. I mean, this is something 3IM has aimed to do as well, but also a good example is, for example, the industry association that was created for electric mobility companies in Kenya. So this is also happening sort of organically by companies themselves that aim to sort of lobby for themselves and advocate for themselves, but again, creating opportunities for pilots and bringing the voice together also helps in sort of creating that pathway between private sector and government. And that's all from us with respect to the paper. Thank you. Over to you, Ben.
Thank you, Chaitanya. And to the other presenters and paper authors for this overview. Let's turn to the panel now and get into a discussion of some of these key issues that are happening. We have some great folks joining us from around the globe. We have Joe Chada, who is Deputy Director of the New Urban Mobility Alliance, Astrid Haas, urban economist with the African Development Bank, Natalie Wong, the Mobility Portfolio Growth and Investment Lead at Shell Foundation, and Karthik Gopal, who is Senior Industry Specialist for Electric Vehicles at the International Finance Corporation. So welcome to you all, and thanks for taking the time to join us. I'm just going to actually start with Joe Chada. If you could talk, there's been this discussion in the paper of what is impact in the mobility sector. When we're talking about impact-driven investments, whether they're coming from an impact investor or an institutional investor, what do we see as impact? We talk about accessibility, carbon emissions, safety, but what do we really talk about when we think about impact in the mobility sector? So go ahead.
Thanks for having me. That's a really great question. And I think Adam did a really good job of sort of teeing up the complexity of thinking about impact in transportation, given that it is a means to an end and not an end in itself. And I think you're very right that there are these aspects to it around the environmental impact, around the economic impact, whether that's access to jobs or to education or basically to the economy. Transport is your gateway in some sense to participating in the economy. Or societal impact, whether that's around gender equity, racial justice. I think that, there are a number of impacts, but I think to layer on another aspect is to think about sort of the scale of the impact as well, whether it's at an individual level impact, or whether, again, it's at a city or region, or even economy level impact. So I think that presents big challenges in terms of what angle are you sort of looking at the transportation question from. For the work that we've been doing, which is with city governments, city administrators, right now I'm working with cities primarily in the US. What is interesting is the way the conversation is shifting from thinking about the speed of vehicles and the level of service that the transport infrastructure is able to provide, which is generally measured, I think, in terms of speed, and shifting that question to, as you mentioned, Ben, to a question of access, both from a point of view of, how does where are those gaps in access and how are we starting to address them, while marrying that question with two other very large questions of emissions, of climate challenges, and of equity in the city. So I'll stop there at this point, Ben, but would love to circle back and get a little deeper into some examples that we're seeing in the US.
Great. Well, let's get back to some of those issues with how these companies actually should be improving equity and accessibility and not actually doing the opposite, and how that can be shaped. Astrid, actually on this topic of equity, most cities, and especially in sub-Saharan Africa, as Hayne showed, people move by what we call the informal sector or paratransit, the minibus taxis, the boda, the motorcycle taxis that dominate the way that people move in terms of surface transport. And then there's people who don't even have access to those systems because of what you might call transport poverty. But I wonder, how can government and private sector, through these investments into enterprises, work together, particularly with these what we call incumbent operators, the paratransit, the bodas, and the like, auto rickshaws in the case of India. But from your perspective, from the African region and perhaps from the African Development Bank, how this sort of synergy might take place.
Thanks, Ben, and thanks to the authors for a great report. I think what is very interesting about this report, sort of trying to marry impact investment and transport mobility, is that obviously as you grow in scale in terms of transport options, and you sort of reach to, let's say, public transport, right? public transport is inherently not financially viable in most places in the world. So what we're talking about here is very much the transport sectors that in an ideal world would feed to the feeder systems, right? And we saw that in Titania and both in Anna's presentation, that when you talk about these new mobility options, they're relatively the small capacity options where you find these enterprises taking place, but also where you find the sort of financial impact happening. Now, what does that mean in terms of the sort of government private sector relation? Well, I think it's very interesting in terms of two broad points. The first one is essentially the report makes the point that most of these investors are international, yet most of the needs are very, very localized. I think, speaking from my own city in Kampala, the boda sector, and WRI is doing some great research on this, right? But even untangling that is really difficult to understand the complexities, the politics, the social nature behind it. And that's very difficult for an investor to understand coming from somewhere else. And then the second point, again brought up by both Anna and then Titania very well on her last slide, is that navigating this policy space is extremely important. And I think Titania used the word demystifying, but there I think my point is how do we get, you asked the question of how we get these two actors to work together. Well, I think, the point is they must, because the transport sector inherently brings the two together, particularly in a case where paratransit runs the transport sector. But I think the point is that each should focus on their comparative advantage. The paratransit sector has figured out how to provide transport, the supply, the demand, the pricing model that people, the majority of people can use. If not, and it's definitely not perfect because there's some who can't use it for affordability. Quality leaves a lot to be desired for, as does safety. So that's where the government comes in and needs to be the regulator, right? And not try and provide the transport itself, but try and understand the sector and help support it through appropriate regulation. Anna mentioned the lack of regulation allows for a lot of private sector options to emerge, but that's not necessarily good because they outcompete each other on relatively low capacity road space, particularly, for example, if we talk about my city, Kampala. So how can we get the regulation to be as effective as possible so that not only an investor sitting somewhere internationally can understand it, but more importantly, that those private sector firms who are already doing the task that they're doing, which is providing transportation, are incentivized to do that better.
Great. Well, we'll come back to that point about regulation. I may have a follow-up question for you there. Let's turn to Karthik Gopal. You're coming from the perspective of an institutional investor and from the International Finance Corporation. How can we achieve both impacts and financial returns in the transport sector in emerging markets? And, is this possible? And how is, IFC potentially navigating this? And I know you're particularly focused on the electrification of mobility. So perhaps you have some perspectives to share there.
Thank you. I do wish to share my congratulations to the authors for a really beautiful paper, a lot of deep insights and research. So thank you very much for that, and also for having me here. At IFC, as part of the World Bank group, I would say that this whole exploration of how do you blend impact into financing is something that we look at as a journey. It's not something that we are able to crack on day one, but something that we do want to build upon and start with those things that are definitely doable today and build towards those that will have to be worked upon, right? So to do that, we kind of look at it in two perspectives. One is a strategic approach, which is about signaling who we are and what do we care about. And that is the tactical enforcement approach of what kind of specific things we do during a project. So let me elaborate a little bit more. So when we talk about the signaling and strategic aspects of it, what we are saying is, for example, from the World Bank's perspective and IFC's perspective, we have set very clear targets for ourselves that in the case of IFC, for example, We are already doing more than, like in 2020, we did little over $20 billion of climate finance. But by 2023, IFC would, all of the funding that IFC would do, 85% of that would be Paris aligned with reference to that particular country where we are doing the financing. So if a particular country where we're doing the financing has nationally determined contributions and commitments that they're not going to, let's say, introduce non-electric buses in public transit, then we would not fund that. Any project that is not aligned with that country's NDCs would not get a funding from the World Bank Group. And this will become 100% by 2025. So putting out our own commitments on what we care about and how do we want to set targets toward that is the starting point from which we look at this. Then comes the actual execution part of it, which is the tactical parts of what do we enforce. So here we have our own very clear framework for assessment of projects, which includes, of course, the climate angle, which then in the transport sector largely looks at electrification, but more broadly around the entire ESG aspects of it. So for example, if we are looking at a public transit funding project, I know that this is not exactly the topic of this paper, but I'm just putting that out as an example of anything that we would fund, even if it were a paratransit shared mobility project. We would look at, is the entity itself having the right kinds of commitments for the way they treat their stakeholders. So for example, if it is driver owners, then what is the kind of contractual agreements that are there? Are they adhering to, of course, the baseline is supposed to adhere to the national regulations and laws, but over and above that, what else does it mean? So kind of putting together these and is it gender inclusive? Is it inclusive for the other, excuse me, the disadvantaged sections of society? So bringing in these kinds of explicit requirements as part of the bar that you have to meet in order to get an IFC funding indirectly imposes those kinds of requirements on our investees and then helps to raise the bar on those aspects. This is, like I said, I want to go back and mention that this is not a done deal. It's still a work in progress, but this is the way we are approaching it. And what we realize is that gradually that putting these things may seem like a cost initially, but I do believe that these create risk mitigations in the longer term, and therefore there is a traditional payoff for that. In addition to these two, there are two other things that we do. One is, of course, we are a patient capital, so we can take longer tenure financing projects. We can be more patient in the way we structure the terms, as long as it's not severely competing with the local financial institutions. IFC would not do that. So therefore, it gives more patience for these kinds of new mobility models to emerge and find their space and profitability. The other part we do is we are running there's a huge department that we have created called Upstream, where we get involved in early stage market creation activities. These could include regulatory support, like what Astrid was mentioning. It could also include financing for pilot projects and those kinds of small scale sandboxed projects that can try out the viability of new models. And then hopefully it can scale to a point where IFC can bring in mainstream investment. That's our hope, but at least it allows us to participate in these kinds of experiments that hopefully can scale and grow as well. These are some of the ways in which we are trying to include the impact aspects into the way we do the financing itself. Thank you.
Great. Thank you. Those are very good perspectives to hear from the point of view of a large investor like IFC, and also good to see the move towards Paris alignment with every transaction that will include that. That seems to have a clear link to actual impact, other than just merely transactional. So why don't we go to Natalie Wong? Natalie, you come to us also from an investor's perspective from the Shell Foundation into several mobility enterprises in Africa, particularly in India. And, I wonder if, do you want to give us sort of a description of the impact thesis of Shell Foundation and what you see to, sort of that impact thesis, but how it may also be linked to like a road to profitability for these businesses?
Yeah, thanks, Ben. Before I do that, I just want to say thank you for everyone who presented the paper on Kampala and Hyderabad. And I want to say how unique the paper is, because it's, as far as I know anyway, there aren't really research out there that takes a bottom-up approach, interviewing different enterprises and really understanding their perspective of challenges in impact investing space. So congratulations to the team. Shell Foundation, the way that we look at impact, we work to expand affordable and equitable access for low-income communities, more and more so in a way through cleaner alternatives, right? So for these solutions, we focus on and believe, most of these mobility solutions are inherently safer and would improve gender equity as well. And the stage of companies that we typically work with are seed and Series A stage company, and we work to incubate them, co-create the solution, and then help to scale these sustainable mobility solutions by providing catalytic support to enterprises and ecosystem-based solutions. So these could be grant used in such a way that we don't aim to displace any equity, but to de-risk and crowd in commercial investments, such as commercial or more patient commercial investment like IFC investments as well. We don't do one-time grant funding. We typically do multi-round support to help the enterprise to the point of attracting investments and demonstrating a commercial business model. And we also look at, sector level needs. So one example would be creating a blended finance instrument using our grant to support commercial investments into supporting asset financing and working capital needs in a sector, which we see more and more important in the case of the electric vehicle sector. In terms of entry point of how we support mobility companies, in the urban space, we have done a lot of work in supporting the likes of, for example, SafeBoda in professionalizing informal transportation with commercially viable technology supporting, cleaner and more efficient mobility solutions. So we see some of these internal combustion based solutions to be a conduit to future transition towards electrification, because at the moment, Anna talked a lot about the reality of how things are. It's still chaotic. It's very much fuel-based transportation, but you see a lot of investments coming into supporting electrification of transportation. So we do see the role of supporting professionalization of matatus and bodas in order to allow that transition to eventually happen. When we look at pathway to profitability, it really depends on the business model. I would say ultimately we look at each business as a standalone business, as you would in fintech and edtech. It's all about what assumptions there are and what challenges the company would face. But we always start with a unit economics of the company and understand what are the drivers and what are the assumptions that are critical in reaching a break even. So for a digital-based solution in transportation, your metrics might be around active users, number of times they use your service in a month, number of drivers, number of users. And if it's like a data-driven company, well, how do you intend on monetizing the data that you're generating? And for an electrical vehicle company, it may be the number of vehicles deployed, energy provided through number of swaps per day. If it's a battery swap company, there are assumptions around electricity tariff, price of fuel, range of batteries, et cetera, et cetera. And you can look at a business to some companies will look at getting to scale, and then profitability can come later if it's a platform-based solution. But we see that that typically is quite hard to do. So we try to focus on unit economics very early on. And then the final thing is, even though we look at each company, when we look at each deal and also at the investment committee at their unit economics, what is unique to transportation, I would say, is the assumption and levers tend to profitability and scale tend to be more and more tied to systemic and regulatory factors. So in the case of electric vehicle companies, if they're like electricity tariff is very much tied to regulation. The price of fuel is systemic and economic. So these are things that we are very aware of. And in the informal transportation space, there's a lot of, political forces in play, as well as a very powerful industry. So I think that is something that we're patient about and hope that impact investors will be more comfortable about coming in the coming future.
Great. Good to hear those perspectives. And I mean, you mentioned actually the motorcycle taxis company. I wonder if I could turn to Astrid Haas. These are if you go to Kampala, you see the bodas everywhere, right? And these companies like Safe Boda have changed the service a lot, at least for sure on the visibility of it, just seeing all the orange vests all over, as opposed to a few years ago, it being sort of just everyone on their own. But, I wonder, this idea of regulation, when we think about regulation from the government's perspective, what is like smart regulation? I've seen on social media this discussion of the registration fees for boda drivers, right? They need to register, but often many don't want to pay the fee because it might be cost prohibitive. But the government wants to get people registered, right? And that can also help perhaps the companies, because it will, create some kind of formal acknowledgement of every rider. But I mean, this is a complex system. So not just in this per se, but what is sort of this idea of smart regulation by a city?
It's a great question. And my short answer is that it's the regulation that meets both the needs of what is being regulated, but also the capacity for enforcement. And I think that last bit, the capacity for enforcement, is often ignored. And then regulation can be written in policies and in books, but people know it's not enforceable, so don't follow it anyway. I think the boda industry is an extremely interesting example, and also how the face of the boda industry has changed over COVID-19. They've suffered incredibly, but also the boda industry, for a lot of young, mostly majority men who come to Kampala and can't find any other jobs, it's a job of last resort. And so now with the economic crisis, you've seen the explosion of bodas, and that's, on the one hand, to be able to support a livelihood, and on the other hand, if you think about the regulatory effects, that's just a massive oversupply of very, very low capacity vehicles, again on road capacity that just can't take it. I think an interesting example recently, actually, that's happened in the last week in Kampala, comes from the taxi industry, or what in some other sub-Saharan African countries is called the matatu, these 14-seater minibuses. That too is one of the sort of primary forms of transport. It is, relatively also a low capacity form of transport, even more so now with COVID-19 regulations, where they can only be half filled, and so have doubled the price as a result. But they themselves have come together and have formed in the last week one association with one spokesperson, because they see the benefits of it. It gives them a platform to be able to talk to government and to advocate for what they need. But also, if you look at a couple of years ago, one of these many associations that existed before that have now been amalgamated, they also came together themselves because they realized they were out competing each other on road space. So they came together. They invested. They got rid of some of their taxis or their matatus, invested in a couple of larger scale buses. These are the Awakule and Nume buses. Got to 23 buses. And wanted to scale further because they had the route, they had the thing sorted. But then they needed the government, right? And so then again, when it comes to your question of what is smart regulation, what is this partnership? Well, it's then to help them get over that next hurdle. And unfortunately, in this one particular case, it didn't happen. But there it requires as well, I think, and this is across sub-Saharan Africa, at least in my experience, is a shift in government thinking of the informal sector being bad and being the enemy, and therefore regulating to punish them, to thinking that, wow, they're providing a really useful service to our city, and if we could help them do it better, guess what, it would be politically very astute as well. And so, I mean, obviously there's a lot more political economy to that. But as I said, I think in essence about the smart regulation, it's really that matches what the needs are and what the capacity is actually to enforce would be my two basic tenets there.
Great. Kartik Gopal, why don't we turn to you? What are opportunities for investments into electrification in India? You know, the public transport sector, but also the three-wheeler auto rickshaws that also dominates much of the streets in Indian cities as a Boda might when you go to Kampala. So are there opportunities for electrification of these vehicles and investments into like Indian companies that can do this?
Absolutely, absolutely, yeah. So this is, to be honest, it's at an early stages. So the penetration is rather low, but clearly the direction in which it is moving is it's exploding. So the rate of growth is very fast. If one can kind of disaggregate the market, so there is a lot of focus on two-wheelers and three-wheelers for last mile delivery as a service. So that's something that a lot of companies are getting into. So you could have investment opportunities in companies that are actually owning these assets, hiring drivers and offering this as a service. They also manage either through partnerships with themselves, the charging infrastructure setup, because it's relatively easier to charge these two and three wheelers because the battery capacity is small. So there's a lot of opportunity in that space around last mile delivery. That's something that's being focused on a lot. In addition, in general, so there are other ways in which this is happening. There are companies that are coming in to become pure play asset owner companies, asset ownership plays. So they would own the assets, they would deploy those assets to driver owners or to fleets, and they can then operate the services. So you're kind of having the separation between ownership and operations. So that's another play where a financier can fund the assets and enable the operators to operate the assets for either the public transit, paratransit services, or for goods carriage. So these are some of the ways. Then, of course, on the there's a lot of activity happening on the manufacturing side as well. There are companies that are coming in to create these products. And now I'm seeing in the last couple of years that's also further driving down into the component development space. So a lot of indigenous companies coming in to develop motors, controllers, battery packs, and so on. So I think the whole value chain is starting to evolve and grow at a very fast pace. So you do have opportunities in these other areas as well.
Well, that's good to hear. I mean, this might be a good area. It seems like a great area for growth of impact investing in the electrification space. You know, these services are providing oftentimes connections to other forms of mobility, or at least we envisage that to happen a lot, the bodas or the auto rickshaws reaching to public transport. And Joe Chada, I wonder if you could comment briefly on, you know, getting back to this issue of equity and not having, you know, how can these investments be made into companies that feed into a larger public transport system that is, you know, envisaged to form the backbone of urban mobility through, you know, rapid transit systems, but that are complemented by, you know, say private systems that might be providing last mile connectivity. And this might be even done in tandem with government, you know, concessions and the like. So I wonder if you could comment on that and if there's any relevance there to your work.
Yeah, thanks for that question, Ben. I want to maybe bring up the example that is a little far from Kampala and Hyderabad, from Pittsburgh. But I think maybe just the example might serve to illustrate some of the points that you were raising. Pittsburgh has launched a Move Pittsburgh pilot program. They've essentially created and launched 50 mobility hubs across the city. This project brings together a number of private service providers, from bicycle share to scooter share to car share to carpool, and thinking about how electric charging is integrated into that, how transit is integrated into that. So, you know, as this pilot rolls out, I think it holds some maybe lessons for physically how this integration can take place. But I think what is important in this story is maybe what came before this announcement of the 50 mobility hubs and this implementation. Sorry about that. So Pittsburgh launched an RFP calling for the private sector to respond to this RFP. And what was very interesting was that the RFP wasn't for a widget. It wasn't pre-describing what the solution was, but rather it was laying out what challenges Pittsburgh has. And I think that's sort of a shift in framing that's really necessary to move away from the conversation about like, well, how many permits am I going to get? And what fees do I have to pay if I cross X number of kilometers or miles of service provided? You know, how do we come to it? How do we bring investors? How do we bring companies? How do we bring governments together to really think about, to articulate well the problems that are being faced, and then approaching it for, and then thinking about approaches for solutions. And that's essentially what Pittsburgh did. They also asked for a consortium of private sector players to apply together. And I think what that really allowed for is recognizing that no one private company, no one investor can do this alone, right? It does take that entire sort of community to approach these challenges together. So I thought that was a really interesting shift from the government or the city, in this case, having to deal with every single private service provider and thinking about integration with the existing infrastructure, and rather putting the onus on that consortium that would win. To think about how they engage with each other. What does that mean from a data perspective? What does that mean from sharing insights? What does that mean from a community engagement perspective? To even thinking about how do they as a group engage with the existing sort of transit and transport ecosystem. And I think, one other point to consider as we look at these solutions is, I think Astrid very eloquently talked about what are sort of what does that regulatory framework need, and how can it be best suited for the context. I think one other part of the context that I don't have a very clear answer on, but sort of keeps coming to the forefront, is that we see companies or mobility service providers in the formal or informal space competing with each other. And so the great examples that Astrid brought up about consortiums being created in the informal sector, how do we think about the role of government to sort of create a platform where there's healthy competition, but not competition where people are fighting for road space, or where fares are dropping to a point where those sorts of businesses become uninvestable. So I don't think any of these are easy challenges, but I do think it starts from inviting investors and companies, to address challenges, not to come just with, okay, can you connect this neighborhood with that neighborhood or that job center? I think it has to be a higher level question that everyone's aspiring to.
Well, thanks for those comments. I like what the city is saying, what problems exist here in our city and how do we solve those working with private sector. Shifting Natalie Wong to this, topic of, we're going to end our webinar here in just a minute or two. So I wonder if you could give, some perspective from Shell Foundation as an impact investor, and, a call for others to join this space and, make more positive change through these enterprises that can support sustainable mobility. And just from Shell Foundation's experience, how can you best invite investors into this space?
Thanks, Ben. I think when you take a look at the mobility enterprises on the continent, and even more so in India, there's a lot of interest from commercial investors once they get over a certain hurdle of demonstrating the viability of the product, and that the product is actually needed by the users. We've seen that in logistics. We've seen that with some of the ride-hailing companies in East Africa and West Africa. But what is still missing, and particularly for a lot of the solutions in the four-wheeler space for matatus and public buses, is still that impact investment, grant, concessional investments, you know, and also, I guess, lower risk, lower interest rate debt for some of these companies. And it all goes back to the challenges they face on a regulatory side, but also the dilution of their impact. And I've listed some examples from, you know, formalizing the informal transportation space, and the narrative being that we are formalizing this growing number of jobs that are appealing to young men who, you know, don't really have other options. But at the same time, what we care more and more about the foundation now is actually understanding, what does having access mean on a consumer level? What does getting more data mean in terms of their access to opportunities, in terms of their you know, budgeting, in terms of their you know, cost that they amount of money they spend on transportation. All of that I don't think has been super well studied yet, and that's something that the foundation will be focusing going forward. And we hope that that linkage between access to sustainable mobility solutions and actual improvement in livelihoods can be established and mobilize more investment, particularly impact investors, into the space. But I would invite also the impact investors to also look at this linkage and establish the correlation there in order to make their investment, but also see that you know, mobility companies do have that commercial potential, and lots of times when without it's hard to understand how having access to mobility or transportation would impact each person until you actually take it away. I live in London, and if you take the tube away, I wouldn't know how to get anywhere. And positive impact is often very difficult to observe. And so I guess the call is really for, you know, people impact investors to consider some of these opportunities and think about creative ways of using their grants, their equity, as well as debt, to support this high potential sector in terms of impact, but also commercial possibilities.
Great. Well, we're just a bit over time, so thank you. I want to thank all of our panelists for joining us. We've had some interesting perspectives, both on the investing side, on how government can be more supportive or working together or cooperative in terms of the mobility enterprise sector, and how some of these, you know, how we can focus on some key metrics around access, carbon emissions, safety, that gender, that mobility companies can really home in on as far as their potential impacts. I want to thank the co-authors for presenting on the report. For those who want to read more about this, it is all in this working paper that we just released today, and we'll hope to see other people more in the future on this topic. So thank you for joining, everyone. Have a good morning, day, evening, wherever you may be, and we will see you soon. Thank you. And bye-bye.
Thank you. Bye-bye.